Welcome back to the deep dive. Today, we are getting into something that sounds pretty technical, but trust me, the backstory is fascinating. We're talking about tax loss limitations.
That's right. Specifically, things like the passive activity loss rules,
Yeah.
PLL rules, and the at-risk limit.
Exactly. And if that sounds like, tax jargon, well, it is. But the reason these rules even exist, it goes back to the 1980s. Think wild financial schemes, high-income folks finding ways to basically, well, buy tax deduction.
Oh, yeah, it was a huge issue. They were using paper losses from investments to wipe out taxes on their actual salaries.
So our mission today is to figure out how that worked, why it had to be stopped, and understand the three main defenses the tax code puts up now. Tax basis, at risk, and those PL rules. We need to see how they all fit together.
It's like a three-layer security system for deductions.
Okay, let's unpack this.
Right. So to really get why we have these limits, you got to look at the situation before 1986. It was, let's call it the golden age of the tax shelter.
What made it so golden?
Well, you had a couple of things lining up perfectly. First, interest rates were really high back then. Think big deductions just for the interest on loans.
Okay, high rates mean high interest expense.
Exactly. And second, the way businesses could write off the cost of assets depreciation was super accelerated. It was called ACRS, Accelerated Cost Recovery System, much faster than today's system, MACRS.
So businesses could claim huge expenses for assets depreciating way faster on paper than they were in reality.
Precisely. High interest deductions plus super fast depreciation. It created enormous paper losses, even if the business was doing okay cash-wise.
And this is where the, let's say, creative investors came in, like the doctors and lawyers you mentioned.
Yep. Imagine you're a doctor making good money, say $500K a year from your practice, active income, high tax bracket. You don't pay all that tax.
So you look for an investment that loses money. Seems counterintuitive.
But loses money on paper.
Hmm.
So maybe three doctors get together. They decide to buy, I don't know, a small strip mall for $1 million.
Okay, $1 million, big investment.
But here's the trick. They only put in maybe $90,000 of their own money, like $30,000 each.
Wait, only $90K for $1 million property? Where does the other $910,000 come from?
Debt. They borrow it. And crucially, under the rules back then, a lot of that borrowed money could actually increase their tax basis in the investment.
So even though they only put in $90,000 cash, they could potentially claim deductions based on the full $1 million value.
You got it. That massive leverage, combined with the huge depreciation and interest deductions we talked about, suddenly that strip mall is generating maybe, let's say, a $740,000 loss in year one, on paper.
A $740,000 paper loss. And because it was considered part of their investment.
They could use that passive loss to directly offset their active W-2 income for their medical practices. They weren't just deferring tax. They were basically buying deductions to get huge, immediate tax savings.
Okay, let's put some numbers on that. Say an investor, Ryan, makes $350,000 salary. He puts $35,000 cash into one of these partnerships for a 10% share. The partnership has that $740,000 loss.
Right, so Ryan's share of the loss is 10%, which is $74,000.
And without today's limits, he could deduct that full $74,000 against his $350,000 salary.
Exactly. If he's in, say, a 25% tax bracket, that $74,000 deduction saves him $18,500 in taxes instantly.
On a $35,000 investment, that's over a 50% return just from tax savings in year one.
And he probably never even set foot in the strip mall. He wasn't running the business, wasn't really risking much beyond his initial cash. It just didn't make economic sense, and the government knew it had to step in.
Right. Before we dig into how they stepped in, just a quick reminder for everyone listening. This deep dive is based on material from Farhat lectures.
Yes, all the examples and content come from the resources over at farhatlectures.com.
It's a great site if you're an accounting student, CPA candidate, or even a pro looking to brush up. You'll find videos, practice questions, loads of stuff to back up what we're talking about today.
And a big thanks to Professor Farhat for providing this material for our discussion.
Okay, so the government sees this massive loophole. What's the first big fix?
The first major hit was the passive activity loss rules, the PLL rules. This is a fundamental shift in thinking.
How so?
Congress basically said, okay, hold on. Losses from investments you don't actively run shouldn't just automatically cancel out the income from your actual job. They forced taxpayers to segregate their income.
Segregate, you mean like put them in different buckets?
Exactly. Three main buckets. Bucket number one is active income. This is your salary, your wages, guaranteed payments from a partnership, or income from a business you materially participate in.
Materially participate. That sounds important. What does that mean?
It means you're involved in the business on a regular, continuous, and substantial basis. You're actually working there, making decisions, not just writing a check.
So our doctor is owning the strip mall but never visiting. That's not material participation.
Definitely not. So income or loss from that mall wouldn't be active income for them.
Okay, bucket one, active. What's bucket two?
Bucket two is portfolio income. Think traditional investments, capital gains, interest, dividends, annuities, royalties, stuff you get from just owning assets.
Got it. Stocks, bonds, that sort of thing. And bucket three.
Bucket three is passive income. This is where that strip mall investment falls for the doctors. It's income or loss from a trade or business activity where you do not materially participate.
Ah, okay. So the PL rules created these three buckets. What's the actual limitation?
The core rule is simple but powerful. Losses in the passive bucket can generally only be used to offset income in the passive bucket.
So the $74,000 passive loss from the strip mall.
It gets trapped. It can't jump over and reduce the doctor's $500,000 active salary income anymore. It can only offset other passive income if they have any.
Wow. Okay, that seems like it would shut down that whole scheme right there.
It was a huge blow to those tax shelters, absolutely.
Yeah.
But the game wasn't quite over. Even if a loss is passive, and even if you do have passive income to offset it against, or you plan to carry it forward, there are still two more hurdles to clear first.
Two more. After segregating the income.
Yep. The first one is actually more fundamental. It's the tax basis limitation.
Tax basis. That sounds familiar. Isn't that just what you paid for something?
It's sort of, but for partnerships at S-Corp, it's your investment in the entity. It limits how much loss you can take out based on how much you have invested. You can't deduct more loss than your basis.
Okay, so what counts as my basis? What increases it?
Well, it starts with the cash you put in, obviously, and the tax basis of any property you contribute.
Makes sense.
Then, your share of the business's income increases your basis each year. Also, and this was key back in the 80s, certain amounts the entity borrows can increase your basis too.
Okay, so debt was part of the basis calculation. What decreases basis?
Distributions or withdrawals you take out of the business reduce it. And crucially, your share of the entity's losses also reduces your basis. You can't let your basis go below zero.
So the tax basis rule says you can only deduct losses up to the amount of your adjusted investment. But you said earlier that even with this rule, the 80s shelters worked because debt was included in basis.
Exactly. That was the problem. The tax basis rule alone wasn't enough because taxpayers could get basis from debt they weren't personally on the hook for. That's how our doctors got potentially $1 million of basis from only $90,000 cash. They were claiming losses against money the partnership borrowed, not just their own skin in the game.
Which led to the next limitation. This feels like peeling an onion. Here's where it gets really interesting.
Right. Layer 2, the at-risk limit. This came about because Congress realized basis wasn't enough. They needed a measure of your actual economic risk. What could you realistically lose if the business went belly up?
So at-risk is different from tax basis. How?
It often starts with tax basis, but then it specifically targets that debt issue. It forces you to distinguish between debt you're personally liable for and debt you're not.
Okay, you mean recourse versus non-recourse debt.
Precisely. Recourse debt means if the business defaults, the lender can come after your personal assets, your house, your savings. You are truly at risk for that amount. So recourse debt increases both your tax basis and your at-risk amount.
Makes sense. If you could lose your house, you're definitely at risk.
But non-recourse debt is different. With non-recourse, the lender's only remedy is to take the property that secures the loan, like the strip mall itself. They cannot touch your personal assets beyond that.
So you're not personally on the hook.
Right. And that's why, generally, non-recourse debt does not increase your at-risk amount, even if it increased your tax basis. This was the loophole killer. It stripped out the benefit of borrowing huge sums without personal liability.
Okay, so how do you calculate the at-risk amount then?
You can think of it like this. Start with your tax basis calculation, then specifically subtract your share of any general non-recourse liabilities the entity has. Those inflated the basis but don't count for at-risk.
So the at-risk amount is generally lower than tax basis if there's non-recourse debt involved.
Usually, yes. There's one major exception, though, mostly relevant for real estate. It's called qualified non-recourse financing, or QNR.
Qualified. What makes it special?
It's non-recourse debt, but it's secured by real property used in the business, and it generally comes from a commercial lender. Because it's tied to specific, valuable real estate that the lender can seize, Congress decided this specific type of non-recourse debt does count towards your at-risk amount.
Ah, okay. So that allows real estate investors to still get some benefit from leveraging property, even if the debt is technically non-recourse.
Exactly. It keeps real estate investment viable while still curbing the worst abuses.
So let's recap what increases your at-risk amount. It's the cash and property you put in.
Correct.
Your share of recourse liabilities debt you're personally liable for.
Yep.
Your share of that special qualified non-recourse real estate debt.
Right, QNR.
And your share of the business's income, just like with basis.
That's the package. It's all about what you economically stand to lose.
It really is fascinating how they built this second layer, essentially a stricter version of basis, just to stop that leverage trick. Okay, so what happens if your loss clears the PAL rules, clears the basis limit, but then hits the at-risk ceiling? Say your loss is $60K, but your at-risk amount is only $50K.
That extra $10,000 loss is suspended. You don't lose it forever, but you can't deduct it this year.
Suspended due to the at-risk rules, can you ever deduct it?
Yes. Carries forward indefinitely, year after year, until you have enough at-risk cases to cover it.
And how do you get more at-risk basis in the future?
A few ways. You could contribute more cash or property to the business. That directly increases your amount at risk.
Okay, put more skin in the game.
Or you could increase your personal liability. Maybe you agree to personally guarantee some of that non-recourse debt, turning it into recourse debt for you.
Risky, but it would increase your at-risk basis.
Yep. And the most common way is simply if the business starts making money. Your share of future income increases your at-risk basis, potentially freeing up those suspended losses.
Is there any other way to finally use up those suspended at-risk losses? What if you sell your interest in the business?
Yes. Good point. When you completely dispose of your interest, sell your partnership share or whatever, any losses that were previously suspended specifically because of the at-risk rules can generally be deducted in that final year, usually against the gain you make on the sale.
Okay, so there's a final true-up when you get out.
Right. Let's try a quick example. Say Peter invests $32,000 cash in a partnership. No funny business with debt. Let's keep it simple.
Okay, initial at-risk is $32,000.
The partnership makes $50,000 income, and Peter's share is 50%, so $25,000. That increases his at-risk amount.
So $32,000 plus $25,000. He's up to $57,000.
Right. Then Peter takes a distribution, withdraws $2,000 cash. That reduces his at-risk.
Okay, $57,000 minus $2,000. His ending at-risk basis is $55,000.
Exactly. So if the partnership had a loss that year instead of income, Peter could only deduct a loss up to $55,000, assuming it also passed the PL test. Any loss beyond that would be suspended due to at-risk. In this simple case, tax basis and at-risk are the same because there was no non-recourse debt.
It really clarifies how these limits stack up. You have to pass all three tests in order. First, is the loss passive, and do you have passive income? PL rules. Second, is the loss less than or equal to your tax basis? And third, is the loss less than or equal to your at-risk amount?
That's the gauntlet. If we connect this to the bigger picture, it's a carefully constructed system to ensure deductions reflect genuine economic activity and risk, not just clever financial engineering. It directly counters that buying deductions strategy from the 80s.
An elegant solution, really, born from a messy problem. Well, that brings us to the end of this deep dive into loss limitations. Quite a journey from 80s tax shelters to today's rules.
It definitely shows how the tax code evolves to deal with new situations.
Indeed. And before we sign off, maybe a final thought for you, our listener, to chew on. We saw how the 80s problem was driven by high interest rates and fast depreciation. Now think about today's environment. If interest rates were to significantly change again, how might that interact with current depreciation rules and these very loss limitation rules, especially for passive investors in things like real estate?
That's a good one. History doesn't repeat, but it often rhymes, right?
Something to consider. And if you want to keep digging, exploring the specific tests for material participation or the nuances between S-Corp and partnerships regarding these rules would be great next steps.
Absolutely. There's always more detail.
Thanks again for joining us on the Deep Dive. Until next time, keep exploring.